Cathie Wood is the founder, CEO, and Chief Investment Officer at ARK Invest. She joins us here now at Post 9. Cathie, thank you so much for being here.
Great to be here, Don.
So Tim had earlier mentioned this idea of actively managed ETFs, the ones that don't necessarily track just the S&P or some broader index. Is it fair to characterize ARK Invest as one of those actively managed types ETFs?
Yes. We trade practically every day, so we're very active.
So what does that mean when you trade every day? Because there's this idea that passivity or index tracking is what ETFs are all about. They become synonymous, but that's not necessarily the case.
Right. In 2013, I thought the same. I didn't think ETFs had anything to do with what I do. And we started looking into the wrapper and found there was no reason, as long as we were willing to disclose our holdings at the end of every day, there's no reason we couldn't do an active ETF, active equity ETF.
And take us through the strategies. We mentioned that you tilt towards the disruptive type technologies. What exactly does that mean? How exactly do you hone in on the stocks that go into these actively managed exchange-traded funds?
Sure. Well, our screen is not a benchmark. Our screen is our research. Our starting point is from the top down, and we're looking for learning curves or cost curve declines that are associated with technology, and they're fairly consistent over time, depending on the technology. And from a timing point of view, we want to make sure that we're ready for prime time. So we ask the question, once we figured out the cost decline, okay, for every percentage point decline in price, how much does demand increase? Are we ready for prime time? So in the late 90s, if we had asked that question about most of these technologies, the answer would have been no. And yet investors were chasing them and valuing them on eyeballs and other such things. Today, they are happening. We're ready for prime time. And the fear I see out there when it comes to volatility or disruption or anything that's not in an index is palpable. That's the real opportunity. The dream was too early. Anyone who chased it got burned. Today, they're afraid. They should be moving into it.
So Tim, you opened the door to this discussion when you brought up actively managed ETFs.
Yep.
So as we talk about it, I mean, you're an active trader. You are a trader on fast money. So how exactly do some investors or even asset managers look towards creating products and then actively trading the portfolio to create value that is then passed on to the holders of those particular instruments?
Look, if as an investor, you can invest alongside of a manager, invest in a manager who is actively monitoring a portfolio and going through the same stress testing that a long-short equity manager, for example, which is what I did for 13 years, is doing. You're getting the best bargain in the business. That's when you really have to ultimately understand who you're investing in. So to the extent that managers like ARK Invest can be taking this area of the economy where there's enormous innovation and where there's an opportunity, I think that's fantastic. The question really is, do investors totally understand the investment approach of the manager? And I think it's great to have Cathie here because I think there's some controversial stuff that she's been involved in.
Well,
that I think we
let's
can
talk about
understand
that because the reason. So Cathie, for better or worse, because there's always two sides to a story, you at ARK Invest have become very closely associated with one stock in particular, and that is Tesla, because you made a lot of waves by attaching a $4,000 price target to the shares at one point.
Yes.
This means that you are obviously very bullish on Tesla and you do hold it in the funds. Is that correct? And if so, is it just a buy and hold, hope it pans out for the next 20 or 25 years? Or is it something different in the way that you approach this particular holding in Tesla?
It is our largest position, but before I go into that, our conviction has increased in the last year or so. It's our largest position. It's down about 29% this year, and it's always been our largest position this year. And yet our fund is up 28%.
How is that? How does that happen?
Yes.
How does that happen?
It is because last year, when genomics was under assault because of reimbursement concerns and pricing concerns and so forth, we were leaning into those heavily. So you buy low, right? We were leaning into those. And so our second largest position, Invitae, which we think is one of the most important molecular diagnostic companies out there, riding down the cost curve of DNA sequencing, it's up 125%. It got as low as $5 last year. Today it's $18. So leaning into that has really paid off. And it's true with the entire genome sector. We're doing the same this year with Tesla, but our conviction level there is so high that it never left our top position.
How could it be so high? I mean, Tim, this is a stock that is, if you look at a chart of Tesla over the course of the year to date and the 1 year period, this has at best been a roller coaster ride. So, at worst been one that's trending lower.
But first of all, it's great to have you here, and congrats on the performance in the portfolio, because I think there's no question there's an active component to what you're doing, and I think I would like to invest alongside of that if I was an investor. With Tesla, I guess there's two questions. I think there's been some obvious issues in terms of performance and some obvious issues on the balance sheet, but that's my interpretation. It may not be yours. The first question I have is really just corporate governance risk, because I look at a company, leaving aside an SEC investigation that one might argue is overdone. I think it's a company where disclosure and consistency and the same standards I would hold to any company, somehow for this company, no one seems to hold them to it. And how do you approach corporate governance?
So we have a 6-point scoring system. All of them incorporate ESG in some way, shape, or form. First one is people management culture. Nothing bothered us about what Elon was tweeting or anything until funding secured, which once we found out that was not true, we said, okay, that's not good. And so we did ding Tesla for management when that happened.
Does that mean a higher discount rate? I mean,
yes.
Mechanically, what does that mean?
Yes, but you know what our target is. It's
not going to really move.
No. Yeah. But within a month and then 3 months, 2 of our other scores started soaring. One was we learned about their artificial intelligence chip. We saw the specs. And our analyst, James Wang, came from NVIDIA. That's what they're replacing. And he said, oh my goodness, and he's going to write something this Wednesday about it. This leapfrogs the competition. And they're at least 3, if not 4 years ahead of the competition. And then a few months later, execution went up when not only did they not lose in the third quarter $700 million, but they made, this is cash flow, $1.4 billion. So that was a miss in terms of consensus expectations of roughly $2 billion. That's what happens with exponential growth.
So Cathie, though, I mean, let's put this in perspective also. The stock is down for a reason, partly because there's a fear of a possible capital raise that has to happen down the line. They may have to issue more stock, raise more money, and that's going to dilute existing shareholders. Are you concerned about that aspect of Tesla, that they are burning through cash and that they need to raise more, and that could put pressure on the stock?
Well, I believe that's in the stock.
Or would you welcome that?
Exactly.
Is really a question I have, because what I wonder is why this is a company who has enormous cash burn and an enormous opportunity. This is the $1 trillion idea with $1 trillion worth of issues around it. And I would be out there raising money tomorrow. Can the company not raise money?
Sure. Oh, it can raise money. I don't think Elon wants to do it at this valuation. I think he thought, and the company thought, that their autonomy day last week was going to give them a nice opportunity, that once analysts understood how far ahead of the competition they are, whether it's Waymo or Cruise, in terms of autonomy, and how soon it is going to evolve, and that they would be able to raise. What happened last week came clear to me is the analysts following this stock don't know how to analyze it, because it's not a technology stock. It is that. It's not a car company. Yes, it is. Battery. It's utility. It's something for everyone, and no one can pull it all together. We have set out our research teams. We have broken them out not by sector, but by innovation platform. So we have a robotics, autonomous vehicles or robots. Energy storage, they will be electric. Artificial intelligence, they will be powered by artificial intelligence. Transportation as a service, we have 4 analysts collaborating on this. I don't think research departments out there are set up to analyze this stock. There is an amazing inefficiency in this stock. It is our highest conviction idea for a reason.
So let's do this. Tim, you as a manager and a former long-short portfolio manager have traded around positions, trimmed, added to, that sort of thing. Is it fair to say, Cathie, at ARK Invest, that just because Tesla is your top holding, that you just hold it there, or are you constantly managing around that position in and out?
So disruptive innovation is characterized by controversy and volatility. And so we know we're going to get opportunities to buy stocks. We lie in wait for those opportunities. Many people think of, because of what we do, disruptive innovation, that we're momentum driven. Absolutely not. We lie in wait. So if you just take Tesla alone, 2018, you're right, the roller coaster. If you take away the performance of the stock, which was up last year, just take that away and just look at what happened, what we delivered in alpha because of our trading around controversy. We delivered 175 basis points just from Tesla. And we get opportunities like that throughout the portfolio.
And I think that's impressive. And I think that's kind of a manager that I would want to be tactically, along with a fundamental view, invested with. I would push back on that volatility. First of all, congrats for laying in the weeds and buying stuff cheap, and that it's been proven out this year in your portfolio. But I look at a stock like Tesla, and over a 5-year period, the stock's done nothing, with being one of the most volatile stocks in the world, at least of the mega cap stocks. So I look at, and I could cherry pick numbers, but I could say, really off the high of 2014, you're down 20% by holding Tesla for 5 years when supposedly it had a huge competitive advantage. Yeah. There was no competitors in their space. Right. It was being priced as a technology company. And the stock really at a point where now it looks like there's some balance sheet issues. The competition's never been heavier, although I think you'll push back on that. I think I appreciate your argument, which is that they're not an auto company. They're not a tech company.
But even more, just let's take the electric vehicle. The Model S, 2012 it was launched. Yep. Not one of those competitors is anywhere near it. We're 7 years later. Now let me take your other point. This trading around, this trading range, you as a trader and investor, but as a trader also, understand that when you build a base like that, one of two things is going to happen. It's either going to break down, and that's what a lot of the bears have been betting on, and they've been throwing everything at it, or it's going to break out. Clearly, we believe is going to break out. And the longer the base, you say 5 years, the longer the base, the bigger the breakout. So we're really looking forward to that.